Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm your host here at AlgoBot, and today we're exploring an expert advisor called Elastic Tension Reversion. This strategy borrows a simple idea from physics, the spring, and applies it to price. It uses an exponential moving average as a resting point, and the average true range to measure how far price has stretched away from it. By the end of this video, you'll understand exactly how it looks for a stretched market that is beginning to spring back toward balance. Let's dive in. Elastic Tension Reversion is a mean reversion expert advisor built around a single, intuitive idea. Price behaves a little like a mass on a spring. Imagine an exponential moving average as the spring's natural resting position, the level the market keeps drifting back toward. When price pulls far away from that moving average, the strategy treats it like a stretched spring storing elastic tension. The further the stretch, the stronger the pull back toward balance. To measure that stretch in a fair, adaptable way, the strategy divides the distance between price and the moving average by the average true range, or ATR. ATR represents the market's normal jitter, so a stretch of 2 ATR means the same thing whether the market is calm or lively. This keeps the approach volatility-aware across different symbols and time frames. But a stretched spring on its own is not a signal. In a strong trend, price can keep stretching without ever coming back. So this strategy adds two important filters. First, it waits for the spring to actually begin releasing. It looks for the bar-to-bar velocity of price to reverse back toward the moving average. Second, it only operates when the market is relatively flat, measuring the slope of the moving average against ATR and stepping aside when a genuine trend is underway. It runs on a single time frame, reading whatever chart period you attach it to, and it uses just two classic indicators, an exponential moving average and ATR. That simplicity makes it a useful teaching example for anyone studying mean reversion logic, volatility normalization, and regime filtering. As always, remember this is educational content only. Every strategy carries risk. Losing trades are a normal part of trading, and nothing here is financial advice. Let's walk through the exact logic the strategy follows. It only acts once per closed bar, so it isn't reacting to every tick. On each new bar, the strategy first calculates three things: the exponential moving average as the equilibrium, the ATR as the volatility scale, and the displacement, which is simply the closing price minus the moving average. A positive displacement means price sits above equilibrium. A negative displacement means it sits below. Next comes the stretch test. The strategy divides the absolute displacement by ATR. If that stretch is smaller than the StretchAtr parameter, 2.2 by default, nothing happens. Price simply isn't far enough from balance to be interesting. If the stretch is large enough, the regime filter checks whether the market is flat. It measures the moving average's slope over the slope lookback period, 8 bars by default, and divides it by ATR. If that slope is steeper than the SlopeAtrMax setting, the strategy concludes a trend is stretching the tether and stays out. Springs only make sense in ranging conditions. Then the strategy checks velocity, the change from one close to the next. For a long setup, price must be stretched below equilibrium. The previous bar-to-bar change must have been down or flat, and the latest change must have turned up. That upward turn is the spring beginning to release. When all three align, the strategy signals a buy, aiming back toward the moving average. The short setup is the mirror image. Price must be stretched above equilibrium, the prior velocity flat or up, and the latest change turning down. When those line up in a flat regime, the strategy signals a sell back toward equilibrium. Now the exits. Every trade is protected by a fixed stop placed beyond the recent extreme, set at StopAtr times ATR 1.6 by default. The primary take profit is the moving average itself, because that's the spring's resting point. If price has already reclaimed the average by the time the order goes in, the strategy uses a fallback target of TargetAtr times ATR 2.5 by default. On top of that, there's a dynamic return to rest exit. While a trade is open, if price reclaims the moving average, the strategy closes the position and banks the reversion, even if the exact target level was never touched. Only one position runs at a time per magic number. Here's the heart of the strategy as it appears in MetaTrader. At the top are the inputs you can adjust. EMA period, defaulting to 34, sets the moving average that acts as the equilibrium. ATR period, 14, controls the volatility scale. StretchAtr, 2.2, is how many ATR's price must be stretched before a trade is considered. SlopeAtr and SlopAtrMax define the flat regime filter. StopAtr and TargetAtr shape the exits, and lots sets the trade size. Below the inputs is the decision block. First, displacement is the close minus the EMA. If the absolute displacement divided by ATR is below StretchAtr, the function returns and does nothing. Then it checks the moving average's slope over the lookback. If that slope relative to ATR exceeds SlopeAtrMax, it returns as well, skipping trending markets. It also computes V0 and V1, the latest and prior close-to-close changes. Now the two signals. The buy branch fires when displacement is negative, meaning price is below equilibrium. The prior change V1 was down or flat, and the latest change V0 has turned up. When that's true, the entry is the ask price. The stop is set 1.68 ER below the entry, beyond the extreme, and the take profit is the moving average itself, with a fallback further out if the average was already reclaimed. It then calls trade.buy. The sell branch is the exact mirror. Displacement positive, V1 up or flat, V0 turning down. The entry is the bid. The stop sits 1.68 ER above it. The target is the moving average, and it calls trade.sell. Two clean, symmetrical rules driving the whole system. Let's bring the whole idea to life on this chart. The smooth line running through the candles is the exponential moving average, our equilibrium, or the spring's resting position. Notice how flat it stays across the whole sequence. That flatness is exactly the ranging condition this strategy wants. The regime filter is happy here because the moving average isn't sloping strongly in either direction. Watch the left side of the chart. Price opens right around the equilibrium line. Then a run of bearish candles pulls it steadily lower. Each candle closes a little further below the moving average, and the gap between price and the equilibrium widens. This is the spring loading up. The strategy is quietly measuring that gap, dividing it by ATR, and waiting for the stretch to reach at least 2.2 ATR. By the fourth candle, price has pulled well below equilibrium. The spring is stretched and storing tension. But a big stretch alone doesn't place a trade. The strategy needs the spring to actually begin releasing. Look closely at that fourth candle. After several closes drifting downward, the close finally ticks back upward. That change in velocity, the prior move down and the latest move up, is the release signal. With price stretched below equilibrium, the velocity turning up, and the regime flat, all three conditions align, and the buy entry marker appears. The stop loss is placed below the recent low, a safety distance of 1.68 ER beyond the extreme, in case the reversion fails and price keeps falling. Now follow the trade. Over the next couple of candles, price climbs back toward the moving average, exactly as the spring model suggests. As price reaches the equilibrium line, the take profit marker is reached. The primary target is the moving average itself, the spring's resting point. The reversion has played out. Price stretched away, then eased back to balance, and the long trade closes at the target. Remember, the strategy also has a dynamic return to rest exit, so even if the exact level weren't touched, reclaiming the moving average would have closed the position. Now watch the market do the same thing in reverse. After tagging equilibrium, price keeps pushing higher, and a run of bullish candles carries it well above the moving average. The gap opens up again, but this time on the upside. The spring is now stretched in the opposite direction, and the strategy measures that upward stretch against ATR, waiting once more for it to reach the 2.2 ATR threshold while the regime stays flat. At the eighth candle, price reaches its highest point, far above equilibrium. Then, on the ninth candle, the velocity turns over. The prior change was up, the latest close turns down. That downward turn is the spring releasing on the short side. With price stretched above equilibrium, velocity turning down, and the regime still flat, the sell entry marker appears. The stop loss sits above the recent high, again 1.6 ATR beyond the extreme, protecting the trade if price were to break higher instead of easing back. From there, price falls back toward the moving average over the next two candles. As it settles onto the equilibrium line, the take profit is reached, the same resting point that anchored the long trade. The upward stretch has discharged, and the short trade captures the return to balance. Step back and look at the symmetry. Twice the market stretched away from its moving average equilibrium, once below and once above. And both times the strategy waited for genuine evidence of a turn before acting, then targeted the return to rest. The stop beyond the extreme defines the risk on each trade, while the moving average defines the reward. This is the essence of elastic tension reversion: patience for the stretch, confirmation from the velocity turn, and a flat market filter keeping it away from strong trends. Of course, not every stretch eases back, which is why the protective stop matters on every single trade. And that's elastic tension reversion from start to finish. We covered the spring analogy at its core, how it uses an exponential moving average as equilibrium and ATR to measure the stretch, the velocity turn that signals a release, and the flat regime filter that keeps it in ranging conditions. We also walked through both a long and a short example, and looked at the exact code that drives the entries and exits. Remember, everything in this video is educational information only and not financial advice. Trading carries real risk, and losses are part of the process. If you found this breakdown helpful, please like the video, leave a comment with strategies you'd like us to explore next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.